All right, awesome. Well, thanks for being here again, everybody, for our fourth session here on investing in real estate. For those of you that don't know me, I'm Sean Casper, and I am the managing director here at Coastal Investment Company, and we are a private equity real estate investment firm based out of Central Florida, where Matt actually is right now. And I've known Chirag for a number of years. I come from the residential real estate space. I was at Compass for a few years there as the regional vice president. And over the years of me being in the business, I've trained thousands of agents and coached them and helped them with marketing and grow their businesses and farming, really all over the Southeast. When I was at Compass, I was responsible for a little over 200 employees and 3,000 agents, and managed the whole area here before moving over to the capital market side of the business. And Chirag had asked me 6 months ago to be one of the expert mentors and help agents on investing in real estate. So the first session we did, we talked about the different types of investing and what are the benefits that come with it, right? Cash flow, leverage, depreciation. Then we talked about maybe getting your clients to invest in real estate, right? Sending them out a questionnaire. How can we get them to invest, and how can you ask those important questions? Maybe after you sold their home, what are they going to do with that money they're taking off the table? Are they going to invest it? Are they going to invest it with you, or are they potentially going to contact their financial advisor and ask them? And we talked about how to sort of make that conversation happen, which might not be happening right now, and asking all of your clients to generate some leads and asking them to invest. And this last one, we talked about diversifying your portfolio into different types of real estate assets. And today, out of the sessions, we're, as an expert mentor on one of the sessions, we're allowed to bring a guest, and there's nobody else I would bring except for Matt, especially based on his background and his knowledge. And Matt is one of the advisors for us here at Coastal RPE firm. And Matt is a very impressive person and human, and we've been friends for quite some time. And Matt is, just to give you a little bit of a background on him, aside from being a certified financial planner, he specializes in tax shelter and private equity consulting. He's a CFP, as I mentioned, financial columnist and national media source. He's an author. There's actually a picture of his book there called Tax Alpha Solutions through Forbes Books. He's trained thousands of CPAs and CFPs on taxes, and very experienced, which is one of the reasons he's here today when it comes to 1031 exchanges, which are DSTs, right? Opportunity zones, oil and gas tax credits, C-store, a lot of different real estate tax solutions that Matt's going to be here and share with us. So I hope that was an okay introduction, Matt, for you. And I will let you take it away. And the floor is yours. If you need anything, I'll be here moderating and getting these slides rolling. So go for it.
Good. Appreciate it. I'm gonna have to take you with me everywhere. I need a hype man like that. That's good stuff, man. Love it.
Let's go.
Look, I'm not special. I'm like everybody else. I've just leaned into the education and learning how to do things at a different level than most people do. All this can be taught and all of it can be learned. So don't think I have any predisposition to be naturally better at this than anybody else, because that's absolutely not the case. So this shouldn't be intimidating. And we have made this presentation today something that should be extremely digestible and very actionable. At the end of the day, you educate yourself so that you can make more money. And if you can better serve your clients while also making more money, then that's a great opportunity. So, okay. So gotcha. Okay. So this is the stuff we did. Sorry, you changed the slide on me. I wasn't ready yet. My brain wasn't there.
Oh, you're fine. I can go back here if you want.
No, you're good. You're good. Enough about it. I didn't even see all that other stuff. That was good. So, okay. When you're out there in the field and you're trying to work with clients, and I've given presentations that are very similar to this. We've adjusted this a little bit to like the CCIM Institute before, so commercial real estate brokers. But at the end of the day, all we're trying to do is help facilitate a transaction. So, and those transactions show up in a few ways. If you're competing with a listing, if you're in a competitive spot with another agent and you're trying to win that listing opportunity or that sales opportunity, having a little bit more knowledge is going to help you do that. when you're trying to get an existing client that might want to sell an investment property, but they just can't, you can't get them off the fence. They won't move. I think some of the information in here will definitely help some of those clients move. Or if you are bold enough, and not everybody is, but if you're bold enough to pick up the phone and be a cold caller, like if we were going to cold call and get listings, getting the largest listings of the off-market property owners you could find in your local area would be this is a tool and this is a strategy that would help you do it. And then I'm going to add something to it that I didn't add before. Every single one of your existing clients that are great clients, that are high net worth, that own investment property, they have other professional advisors that they trust, CPAs, attorneys, so on and so forth. Believe it or not, their CPAs and attorneys don't have the types of knowledge that I'm going to share with you here today. If they did, I wouldn't be doing this for 16 years and I wouldn't have the business that I have. So you're intimidated by thinking that they have this knowledge, but they do not. Otherwise, I wouldn't be teaching this stuff all the time. So let's talk about the landscape of what an off-market or what an investment owner looks like today. And I just pulled a little bit of demographic research. But so what does the average owner of an investment property look like today? Their average age is 67. Over 67% of the people that own investment property today are over the age of 65. Well, they're typically married, husband and wife. And so why is that relevant? It's because those people are at or near retirement age. They are ready to retire, probably travel and do more fun things in their life. And they are tired of the toilets, tenants, trash, and the termites of rental properties. But most of them just don't know what to do to get out of it in a smart way. They would be willing to trade if you can help them trade. So when we look at the rental market, 90% of the rental properties out there today are owned by individual mom and pop investors, not institutions. And 30% of those property owners have owned those properties for over 30 years. That means they've appreciated a lot in value over time, and there is a lot of embedded taxes in the value of their real estate today. And that is a reason many, many people are very fearful to sell, is because they don't know how to mitigate the taxes in the transaction. So let's just talk about what the taxes mean here. So from a federal income tax level, when you're selling real estate, you have federal capital gains, which can be 20%. You have depreciation recapture, which is when you've depreciated something, it comes back as a form of ordinary. And on real estate, it's called 1250 property, and it's capped at 25%. Some states have capital gain taxes as well. I use California. That's one of the high-end options at 13%. Plus, there's the net investment income tax, the NIIT, which is commonly called the Obama tax of 3.8%. So if you add all that together, the taxes that somebody could pay on highly appreciated real estate are somewhere between 23.8 and 41.8%. But yet, when I find realtors going out there and trying to get listings from either in a competitive situation from one of their clients or something off market, they find themselves often haggling or negotiating over what commission can you justify for the services that you bring to the table. Well, typically today, even in a compressed market where people are accepting lower commission rates to do this type of work, you're still seeing 1 to 3% for the sell side and 1 to 3% for the buy side, somewhere in that range. So we're talking about 2 to 6%, depending upon the size of the transaction and how hard they push back on the fees. So here's the premise of this conversation today. If you could solve the 24% problem, they're not going to care about the 3 to 6% fees that you're charging for the commission, because all realtors are saying some form of the same thing. We're going to determine fair market value for your property to list it, and I'm going to bring you qualified buyers. Everybody is saying something similar. This is a real value add proposition. If you could show them how to solve the bigger tax problem, they're probably not going to care about paying you the commission. So here's how a typical conversation might go with an owner of a property that you have a relationship. The owner says, I'd really be open to selling all my rentals. And as an agent, you say, well, why don't you do that? Well, I would, but I'd get killed in taxes. Well, as an agent, you could respond, well, what if you could eliminate those taxes and still get great income with no headaches? And the owners are going to be baffled because they're not getting this advice anyplace. It's, well, really, how would I go about doing that? And so your answer doesn't have to be, I know the solution. It's, I have a professional, I have access to a professional that knows how to do this stuff, that I could certainly get those people on a phone call so that you could better understand your options. And that's really the takeaway. So what are some of the tax saving strategies that you could deploy? A lot of people, I'm sure, are familiar with 1031s. You know, a 1031 is a very common part of the exchange code for investment property. 45 days to identify, 180 days to close. You have to equal to or greater than equity and equal to or greater than debt. But we also do institutionalized 1031s where we sell fractional interest of like apartment complexes, self-storage facilities, like big institutional assets. We sell fractional equity out of those assets that qualify for a 1031 exchange. We also use code 1400Z. It depends on where their cost basis is, which is what you paid for something, plus any capital you added over the years to relative to the sale price. If they have a relatively high cost basis, a great strategy for them might be to use a 1400Z instead of a 1031, because it allows them to pull the cost basis back out of the deal completely tax-free and only reinvest some of the capital gains to get tax mitigation on that. 168K is a bonus depreciation code that we've been using for the past 3 or 4 years. It came in with the Tax Cuts and Job Act of 2017, and we had bundled that together with line item 6, which says C-stores, which is a convenience store program. Think Circle K or 7-Eleven. It allows investors to put money into a fractionalized investment into a convenience store and get bonus depreciation benefits through 168K. We also use things like 263C, which is oil and gas investments for intangible credits. Your clients literally exchange potentially owning above ground real estate, a building, and if they sell it, then they can own below ground real estate, which is mineral rights. Mineral rights give you the ability to offset taxation when you reinvest in those, so creating a really tax smart exit for a seller of highly appreciated real estate. And then 453 is an installment sale code using a dealer. It basically is another way to transact real estate and potentially not have to realize all the taxation associated to it. One of these is not necessarily better than the other. They are fact pattern dependent. How long has the client owned it? What does the client want to do with the money? What's their cost basis? What's their gain? How much depreciation recapture? It's the fact pattern that tells us which one of these solutions would be the most useful for that particular client. So that's why it's not necessarily about pitching the back end solution and saying, here's what you should do with your money. It's about pitching, hey, there are a lot of things you could potentially do that would help you avoid taxation. Would you like to learn more about what those things are and see if any of those fit your goals and what you're trying to accomplish? So at the bottom, I was kind of being a little funny, and I said, didn't anyone ever tell you there's more than one way to skin a cat or to get a listing? The point there is there's more than one way for somebody to exit real estate and avoid the taxes, but it just depends on their facts and circumstances. And there's nothing that sellers of highly appreciated, really expensive real estate hate more than having to pay tax. So if you can show them how to solve the tax problem, they will probably let you sell that real estate. And then, like I said before, if they've got relationships with CPAs and attorneys and other people, if you go to a CPA with this, the CPA likes the idea. It's not uncommon that the CPA might go, I've got a dozen clients that would love to sell right now, but aren't selling because of the tax problem. I'd be happy to make an introduction. So it's been a great way over my career to build referral relationships with strategic centers of influence. It would work for you in the same way.
Yeah, and just to add, you all have teams, right, that you work with, whether they're insurance agents, inspectors, your mortgage brokers, title companies. This is just another person on your tool belt, right? To have Matt, to have me, when it comes from a tax standpoint. Most CPAs, let's say they have 500 clients, maybe 95% of their customers, their clients, they've designed products around somebody that makes between, let's say, $100,000 and $1 million a year. You know, maybe 5% of their clients make over $3 or $4 or $5 million a year. The tax advisors that we have on our team and Matt that are in the private equity space, all the products they've come up with are designed based on when people have large exits of their companies, right? 5, 10, 50, $100 million exits, or they're selling large properties, whether it's $1 million or $5 or $10 million, where there's massive tax bills, right? If you sell a company for $100 million, you're going to stare in the face a $30, $40 million tax bill. So that's just, something that I wanted to add is this is another tool for all of you to have, especially when that tax conversation comes up, whether you're in California, you're in New York, you're in Florida, you're in Chicago, you're anywhere. We can help. And Matt, a lot of the people here, as you know, are brokers and realtors. So majority would qualify as real estate professionals when it comes to from a taxation standpoint, right? They're all real estate professionals out there in the field, but to actually qualify as one from a tax standpoint. So aside from us being able to help them with their clients, we've helped over the years a lot of agents for their own taxes standpoint. So if you would just touch briefly on C-Store and maybe just use one of the agent, no names, but an agent example of somebody that, let's say, made $1.5 million, in gross commissions and netted, let's just say $1 million. And if they wanted to reduce their tax bill, a few $100,000 or something.
Sure. Understood. And you brought up something on one of those statements before. I would say this. I would say you don't have to wait for taxes to come up in the conversation. Put taxes in the conversation. Ask the question to some of your clients that you trust and say, hey, are taxes part of the concern that you have with you not selling these assets? Just you throw it out there. You don't have to know the answers, but throw the question out there. You might be surprised at the response, and they might absolutely say, well, absolutely, that's a big reason why I don't want to sell an asset. And then you're in the conversation instead of waiting for taxes to organically come up. Many clients don't have an expectation that their real estate broker is going to help them solve a tax problem. So they're not going to probably start that conversation with you. So I would ask them. But to your point, so the way that I look at tax planning is, so if you're married filing jointly, from a federal tax standpoint only, the top of the 24% tax bracket is at about $340,000. So everything underneath that is relatively tax efficient in the grand scheme of things when you look at it from a much larger level. So the goal would be to reduce as much taxation as you can and keep everything under the 32% bracket, which is about $340,000. So if you had somebody making $1 million and they were married, federal only, they'd owe about $350,000 in taxes. So as a real estate professional, there could be an opportunity for you to qualify for what we've been doing the past few years, and it's called the C-Store program, falls under 168K. Many people are probably familiar with how bonus depreciation and cost segregation can help a real estate owner save in taxes. It's a very similar mechanism in the C-Store fund. So if somebody's making $1 million and owes $350 in taxes, if they were, instead of taking the $350,000 check and paying the IRS, let's just assume, hypothetically speaking, they invested that $350,000 into the convenience store fund. What would that allow them to do is it would allow them to invest into the fund, get income from that $350,000 of passive cash flow from a triple net lease that was on a Circle K, 7-Eleven, Wawa, some big institutional piece of institutional convenience store asset. And then they would get, as part of the partnerships, they would get K1s that would give them losses that they could use on their tax return to offset their income. So based on the multiples that we've deployed the last couple of years, a $350,000 investment would create a loss of around $850,000 to $900,000. So now your taxable income was $1 million, but if you have losses that now push your income all the way down to $150,000, then you're only taxed on $150,000 at the end of the day. So income on $150,000 is around 10%, give or take. So $15,000 in taxes out of pocket, and all that $350,000, instead of sending it to the federal government, you would now own a $350,000 unit of a fractional interest in a convenience store portfolio that generates 5% cash on cash returns on a monthly basis, so that 5% annualized paid monthly. So passive cash flow that would sit on the books as an asset for you, potentially in perpetuity. We will sell and reposition those assets later, but it's a substantially better tax benefit than writing a $300,000 check to the IRS, because the IRS does not pay you income when you send them money, and the IRS never sends the money back when you send it to them.
Very true. Thank you for sharing that. And just for everybody to understand, I mean, what was the amount of gas stations that we closed on, give or take, in in 2022. I think it was towards the end of the year.
Yeah, we did about $100 million in equity in gas stations last year alone.
Yeah, I think it was 26 or 27 or something like that. That was closed on right at the end of the year. So just for you to have an idea, everybody here, of how this is being done at scale. And these products are out there, but again, your accountant, your CPA, your certified financial planners, they may have heard of these products, but most of their clients don't qualify or aren't making enough income to have to offset it to be able to use these opportunities and these investments. So thanks for sharing that, Matt. And I think there'll be maybe some questions at the end and some follow-up definitely from a lot of the agents here.
Sure. So just kind of gave the fact patterns out. If this were me knowing what I know and the roles were reversed and I were in your shoes, this is what I would want to know. If I was competing for a listing with other brokers, it was a competitive situation. I'll just ask them. I say, we can help you determine fair market value and bring qualified buyers just like any other firm out there. But we also have access to a tax partner that can show you how to defer, reduce, or eliminate taxes when you sell. Would that be interesting to you? Is that a concern while you're trying to list this property? The bigger properties have more taxes in them. Ironically, the bigger properties also pay bigger commissions. So bigger tax problem means a bigger potential commission if you can solve the problem. Getting an existing client to sell an investment property. I know you might be tired of the daily hassles of your rental properties. It gets to be a lot as people build a rental portfolio. Our firm has access to a national tax expert that can help you defer, reduce, or eliminate taxes when you sell. If that was possible, would you let me list and sell your property for you? So just another conversation to have with someone and just float the idea of, if I could make the tax bill go away, is there any reason, would that help us do more business? And then cold calling the biggest off-market property owners. There's a little nuance here that people may or may not have heard of, but most big off-market properties do not sell due to taxes. And that's because they've been given tax advice from their attorneys and CPAs that don't know what I know, that say you should hold that asset until you ultimately pass away. And the reason why is because taxes get wiped out. Capital gain taxes get wiped out when you die due to stepped up cost basis at death. So many CPAs and attorneys have 65, 70-year-old clients that don't want to do it anymore, tired of the toilets, tenants, and trash, would love to sell that asset, but their CPAs have advised them not to for tax reasons. And now that asset sits there for the next 10, 15, 20 years, like dying on the vine. No capital expenditure put in it, not putting in new tenants all the time, and because they just are tired of it and they can't sell it because of the tax bill. So call and ask them and say, could I have this listing if I could show you how to potentially eliminate the headaches of managing your own real estate and get rid of the taxes? That commission they're going to pay you is a whole heck of a lot smaller than the tax bill.
Awesome. Thank you, Matt. That was great. Does anybody have any questions? We have some time for a Q&A. We have a few minutes, or if you have any situations or clients you want to bring up, maybe that is interested in a 1031 or, a DST, or have questions on DSTs or opportunity zones. We have Matt here for another few minutes. Feel free if you have any questions that you want to ask. I'm sure somebody may have some. The last time we got some questions on it. And
Matt,
go ahead.
Mary Murphy, San Francisco Bay Area. I have a client, believe it or not, I sold their house last year and they had to pay a lot of taxes, but they own an income property in a local city that's probably worth about $1.5 million, doing nothing. They have tenants in there that aren't paying rent. So their CPA, as you mentioned, has advised them just hang in there. And the reason is because they are 90. Now, is that my two-part question? Is it worth it for a couple of 90-year-olds? And let me tell you, they are totally compass mentors. They know what's going on. They're brilliant. And the second part of that question is that and I don't mean to be demeaning to them because they're very bright. He was a physicist and she was a librarian, but would they understand the nuances? This is, complicated stuff, or is it?
So look, is it complicated? I mean, Yes. Is it close to particle physics, like what you just described that guy's background is? I would say no, right? So look, what
But
you
they
would
have
want to,
kids. They have kids that
okay,
obviously are going to inherit.
correct. So here's the way you would want to involve and get involved in that case. And by the way, those kids are probably going to be in their 60s, so it's not like they're
They are. Yeah.
youngins themselves, right? So what I would suggest there is you get the kids involved in the conversation and you say, look, if we could show you how to sell that for fair market, $1.5 million, and then I could reposition that asset into something that would cash flow. Let's just assume we could get them 4% annualized income on $1.5 million of equity. Now you're talking about $60,000 a year, $5,000 a month in passive cash flow. They could have institutional ownership and management of it through like JLL or CBRE or somebody like that would manage the next property. So they have no responsibilities for toilets, tenants, and trash and anything. They now get passive cash flow. And then when they die, because eventually they will, nobody lives forever. When they die, they would get stepped up cost basis in that new asset, just like the asset they're holding on to today to get stepped up cost basis in. They would exchange and get stepped up cost basis in the new asset. So they don't lose the reason the CPA is telling them not to sell at all. They just transfer that right to the new property when they exchange. The new property would allow them to get rid of all the headaches of management, allow them to take back free cash flow without having to do anything, and then still not have them pay tax when they ultimately pass away. So you have that conversation with the family, get the family on board, educate them. They take that back to the CPA, get the CPA's blessing. There's a good chance, because that CPA clearly doesn't know what they're talking about, that CPA has another 5 or 6 old clients that they go, oh my God, if that's a thing, I want to tell another 4 or 5 of my clients that that's a thing. Now maybe that becomes a referral generator for you. And then you could go back on this particular client and get the listing and the sale on that transaction.
One last question, sorry to take up all the time, but what's the downside on a C-store investment?
Well, in that fact pattern, it wouldn't be a C-store investment. It's more of a 1031 transaction, right?
Okay.
So a C-store investment is, you have to qualify for C-store, or it has to be considered a passive activity. And so one of the biggest issues with that is we have to make sure that your fact pattern, your facts and circumstances qualify to use it in an active scenario. In a passive scenario, anybody qualifies to use it from a passive fact pattern, but it's the qualification is the key to the C-store. It's not the risk of the underlying investment. It's just a Circle K, 7-Eleven, like the places you filled up your gas tank at numerous times. You know, you go and you fill up your car under the big aluminum roof with 12 gas pumps, and then you walk in and buy a $3 coffee and a banana. Like, that's what a C-store is. And you just own a fractional interest of it while it's managed by an institutional asset manager. And that's how you get the economic benefit of cash flow that passes through, plus the tax benefit of the forced depreciation that pushes through also.
I'm just going to jump into that so we can take a couple more questions. And
Yeah.
Mary, I'll follow up with you so we can sidebar and set up a call with you, Matt, and I, and we could talk about that specific situation for everybody. If you want to reach out, I'll put my email in the chat, and I'm on Chirag's playbook online, so you can reach out at any time. In addition to that question, Matt, Samit said, you are talking about taking advantage of the investment assets only, investment to investment, and not primary home and gain. Is that correct?
So on the sale of a primary home, you get, obviously there's some exclusions, right? For a single individual, 250 of gain. For a married couple, 500 of gain after they've owned the asset for 2 years. So, but if somebody sells a primary residence over that gain exclusion and they still want to offset the capital gain on it, we can do that, but we can't use a 1031 exchange to do it. We would use a 1400Z, an opportunity zone, or some other type of structure to mitigate taxation over that that gain exemption on your primary residence. You can't exchange a primary residence in a 1031. You have to use other codes to chew up that tax.
Matt, will you give this the cliff notes on a op zone? We had a question come in about that as well.
Yeah, so an op zone is pretty simple. So if somebody paid, $1 million for something and it appreciated to $2 million over, a 10-year period in value, and then they sold it, you would be able to pull the $1 million that you bought the property for back out of the equation and put it back in your pocket, go buy another piece of real estate completely tax-free. The $1 million of gain, when the property grew from $1 to $2 million, that $1 million of gain would need to be reinvested into an opportunity zone project or opportunity zone fund to mitigate the taxation on that additional gain. So you pull the basis away from the gain, you separate those two pieces, kind of like oil and water. And the basis you can put back in your pocket or in any other type of investment. The gain has to be reinvested through 1400Z to be able to solve those taxes. Now, I know there's a lot of real estate agents that are under the impression that there's, you know, a piece of real estate listed. It says in the listing, it's in an opportunity zone. And your thought process is, oh, if it's in an opportunity zone and my client has money that would be tax mitigated from being invested in an opportunity zone, then I could just buy them a piece of real estate in an opportunity zone and that would work. The problem is that's not a true statement, because the second qualification of an opportunity zone is what's called a 100% improvement over cost basis, which means if you buy a piece of dirt for $1 million, if you don't put an improvement on that piece of dirt for another $1 million equal to what you've already put into the real estate, then you can't qualify for the opportunity zone benefits. And then there's a whole bunch of other rules as well. That's just the first rule. It must be in an opportunity zone designated area, and you have to put more than, you have to double the amount of capital that you put into it when you first buy it. So most mom and pop type of investors don't have a few million extra dollars on the back after they buy a property to improve it by that much more. So it's hard for a mom and pop investor to execute on their buy for themselves in an opportunity zone investment.
All right.
I hope I answered that.
You did. One last question, and then we'll jump off since we're a little bit over. My client has a property worth 500K. They owe 100. If they do 1031 exchange, how much do they need to purchase? They paid 280 for it.
They have to purchase, so to do a 1031, they have to purchase all 500. They have to replace 400,000 or plus of equity and 100,000 plus of debt. So you have to equal to or greater than on the full asset value, all the equity and all the debt. If any of that is not replaced in equal to or greater than, the part that's not replaced becomes what's called boot, B-O-O-T, as part of the transaction, and it therefore becomes taxable.
Great. Any other last questions? I know we're a little over, but these are great questions.
Yeah, good questions.
All right, awesome. Well, thanks again, everybody, for being here. And I dropped my my email inside the chat, so feel free to reach out for specific situations. And Matt, it was great. We got to see you shine a little bit towards the end there with the Q&A on your wizardry on taxes. So thanks for being here. Thank you, everybody, for coming. And again, reach out if you need anything. Kerry, yes, it is recorded. It'll be on Chirag's playbook. So you can go on there and let us know if you need anything. Thanks again. Thanks, Matt.
Thanks, everyone. Appreciate you.
So long.